We all know there are three major asset classes: equity, debt, and gold. But when it comes to investing, most of us pick equity without a second thought because it gives higher returns than the other two in the long run, and there's no doubt about that. But the catch is, investing only in equity comes with high risk, and yet we don't really bother about it because we assume there's no other choice. But what if I told you there's a strategy that can give you the same return as equity but with much lower risk? And this is not just a theory, I'll back it up with real data from the last 25 years that covers every market crash and rally. So the feast is ready, it's time to serve. Before we get into the strategy, let's first understand how these three asset classes have performed over the years. Let's take a look at their annual returns. To analyze equity, I have taken NIFTY 50 data. For debt, I have considered Aditya Birla Sun Life and HDFC's low duration funds data. And for gold, I have used its historical price data. Now that we have seen the individual performances, let's find out how much equity has outperformed debt and gold over the last 25 years. First, let's look at year-wise lump sum returns of NIFTY 50. This table shows how much your returns would have been if you had invested at different points in time. For example, if you had invested in Jan 2005, then after 5 years, your annualized return would have been 22%. Or let's take Jan 2009. If you had invested 1 lakh and after 15 years, it would have grown to 8.1 lakhs, giving you an annualized return of 15%. Now let's compare equity and debt over the long run. This table shows if you had invested in Jan 2005 and held it for 15 years, equity would have outperformed debt by 6% annually. And over 15 to 20 years, equities have outperformed debt by 6 to 8%. Finally, let's compare equity and gold over the long run. This table shows if you had invested in Jan 2012 and stayed invested for 10 years, equities would have outperformed gold by 11% annually. And over 15 to 20 years, equities have outperformed gold by 2 to 3%. So we have seen that equity has clearly outperformed both debt and gold in the long run. But that's just one side of the story. There's another side to it, that is risk. But to be honest, most of us don't give it the attention it deserves. When analyzing risk in investing, there's one key term you should know. It's drawdown. It's one of the most important ways to measure risk. Let me explain it in simple terms. Imagine you invest 1 lakh at the market peak. If the market falls by 50%, your investment value shrinks to 50,000. This drop from the highest point to the lowest point is called a drawdown. Now let's see how this plays out in real data. Here we have last 45 years of Sensex data. Since Sensex and NIFTY 50 are very similar, this gives us a fair idea of market volatility. The worst drawdown in these 45 years was a massive 60% drop, meaning if you had invested 1 lakh at the peak, your portfolio would have temporarily fallen to 40,000. That's a 60,000 loss on paper. It's definitely not easy to handle. In fact, only 4 out of these 45 years had a mild drawdown of less than 10%. On the other hand, in 18 out of 45 years, markets saw a drawdown of more than 20%. So market crashes are more common than we think. And anyone investing in equity should be mentally prepared for these tips. Now what about debt funds? In debt funds, especially low duration funds are far less volatile. They don't experience drawdowns like equity, and that's why they are considered a safer option for stability. Finally, gold. Many people assume gold is a safe haven with no risk, but that's not entirely true. Gold also experiences drawdowns. Over the last 45 years, gold had a maximum drawdown of 41%. In 23 out of 45 years, gold saw an intra-year drawdown of more than 13%. In 7 of those years, the drawdown was more than 20%. So gold is less volatile than equity, but it's not completely risk-free. So what do we learn from this? Equities gives the highest returns, but comes with highest risk. Debt funds have the least risk, but their returns are much lower. And gold is somewhere in between. Not as risky as equity, but not as safe as debt. So if you invest in equity at the wrong time, you'll face huge drawdowns. And unfortunately, many investors panic and quit when that happens. But don't worry. there's a way to reduce this risk while still earning equity-like returns. And that's where our strategy comes in. So what's the strategy that gives equity-like returns but with lower risk? It's called asset allocation. Now don't let the term confuse you. It's actually quite simple. Instead of investing all your money into one asset, if you invest it across multiple assets, that's asset allocation. For example, let's say you have 1 lakh to invest. Instead of investing 100% into equity, you can split it smartly like this. Invest 70% in equity, which is 70,000, and 15% in debt, which is 15,000, and the remaining 15% in gold. Now, why does this matter? Because by diversifying like this, you can get returns similar to equity but with much lower risk. But does this really work in real life? Let's check it out with real data. Now we will compare 3 different portfolios against a 100% equity portfolio, that is Nifty 50, to see how they perform in the long run. Portfolio 1 is of 70% equity, 15% debt and 15% gold. Portfolio 2 is of 50% equity, 25% debt and 25% gold. And portfolio 3 is of 30% equity, 35% debt and 35% gold. Now, if you had invested 100% in equity, your CAGR, that is compounded annual growth rate, would have been 13% in 7 years, 11% in 10 years, 12% in 15 years and 14% in 20 years. Now let's see how portfolio 1 has performed. Surprisingly, it delivered the same returns as Nifty 50 in all time frames, like 13, 11, 12 and 14%. But here's the real game changer. The maximum drawdown for Nifty 50 was 59%, meaning if you had invested at the peak, your portfolio could have temporarily dropped by 59%. Whereas in portfolio 1, the drawdown was only 40%, nearly 20% lower, but with the same returns. Now if we look at portfolio 2 and 3, the drawdowns were even lower. Portfolio 2 has a drawdown of 27% and portfolio 3 with just 16%. That's a huge difference compared to the 59% drop in Nifty 50. Of course, there's a trade-off. The returns were slightly lower in these portfolios, but the risk reduction is massive and making them much more stable for investors who can't handle big market crashes. Now that we have looked at CAGR, let's take a step further and check rolling returns. By the way, if you are not sure about the difference between CAGR and rolling returns and which one to use for analysis, I have explained it in detail in this video with actual mutual fund data. So do check it out. Now coming back to our comparison. For a 5-year rolling period, the average return for Nifty 50 is 16%. And for portfolio 1, it's also 16%. But here's where it gets interesting. The minimum return for Nifty 50 is minus 1%, while portfolio 1 never had negative returns. Even at its worst, it delivered 3%. Also, if we look at how often return exceeded 10%, in Nifty 50, it happened 76% of the time, while portfolio 1 did even better at 84%. Now let's extend it to a 7-year rolling period. The average returns remains 15% for both Nifty 50 and portfolio 1. But the minimum return for Nifty 50 is 5%, while portfolio 1 has a slightly better 7%. And if we check how often returns were above 10%, for Nifty 50, it was 82% of the time, while portfolio 1 managed an impressive 91%. And as expected, portfolio 2 and 3 had slightly lower returns, but came with even lower risk. So, what does this tell us? With the right asset allocation, you can get similar returns to equity, but with a much smoother and less risky ride. Now let's quickly check how Nifty 50 and all other portfolios performed during major market corrections. The biggest market crash was during Jan 2008 to March 2009. During this period, Nifty 50 crashed by a massive 58%, but portfolio 1 has declined only 36%, which is a solid 12% lesser than Nifty 50. And another major correction happened during Feb 2000 to September 2001. This time, Nifty 50 fell by 50%, while portfolio 1 dropped only 35%, a whole 15% less. And if we look at the other market declines, we can see a clear pattern that portfolio 1 consistently held up better than Nifty 50 and by reducing the downside risk significantly. This proves a simple yet powerful point. Asset allocation doesn't just smoothen returns. It also cushions you during market crashes and making your investment journey much more stable. Finally, to wrap it up, most people believe that only equity can deliver high returns in the long run. But as we have seen, that's not entirely true. With the right asset allocation, you can achieve similar returns to pure equity but with much lower risk. It's not just about chasing high returns. It's about building a portfolio that helps you stay invested no matter what the market throws at you. And that's the real game changer. And that's all for this video. But wait, many investors believe they can outsmart the market. When the market starts falling, they stop their SIPs thinking they'll resume at the perfect bottom to buy more units and get higher returns. It sounds like a smart move, right? But does it actually work? Or is it just another trap that hurts long-term returns? And that's the lead for my next video, so stay tuned. Until then, this is Sabarish signing off.